A journal is a chronological record of the transactions of a company. Entries recorded in this journal are of course called journal entries. Businesses can have various types of journals, but since the mechanics are all the same, we will focus on the most basic of journals, the general journal. First off, we need to know the general types of accounts that businesses deal with on a regular basis. This includes assets including cash, liabilities such as accounts payable, equities such as contributed capital, revenue including service revenue, expenses like salary expenses, and dividends. Here we have a table in which the first column has a list of the accounts. The second column is an abbreviation which makes ALE red, each letter representing each type of account. Remembering this will help when you're doing your journal entries. We must now familiarize ourselves with the concept of a double entry accounting system. This concept is based on the dual nature of accounting, in which the ACCT financial textbook states, every accounting transaction affects at least two accounts. This means that every accounting transaction must be recorded with equal changes to debit and credit balances, which leads us into the next concept of debits and credits. The term debit simply means the left side of an account, while the term credit simply means the right side of an account. This table is a summary of how debits and credits change in different accounts. To remember this table, all you need to remember is ALE red for the accounts, and for the normal balances you need to remember DCCC, because the normal balance and the increased balance is the exact same and the decreased balance is the exact opposite. Now we'll move on to an actual example. Highlighted in yellow, we have the key components of a journal entry, which includes the date of the transaction, the accounts affected, and the debits and credits. To the right, we have our table of how debits and credits change depending on increases and decreases in accounts. Remembering this will help a great deal. First, we'll do an assets example. So first we note the date, the 2nd of the 10th, 2012, the accounts affected, and the debits and credits. So the transaction was the company purchased $200 worth of supplies. So supplies is an assets account and it increased. So an increase in assets account is a debit. Cash is also an assets account, so cash decrease. When cash decreases, it's a credit. Next, we'll move on to a revenue example. So again, we'll note the date, the accounts affected, and the debits and credits. So cash, an assets account, it increased. So it's a debit. A service revenue is a revenue account, and that also increased. So when a revenue account increases, it's a credit.